Hi, welcome to the ICLR Friday Forum for February 9th, 2024. This is one in a monthly webinar series hosted by ICLR, the Institute for Catastrophic Loss Reduction, Canada's leading source for disaster resilience knowledge. Each month, we present recently completed research related to ICLR's mission to make Canada more disaster resilient. I'm your host, Dr. Keith Porter, ICLR's Chief Engineer. Last time on January 12th, we brought you Lars Powell, who showed us that adding IBHS fortified home hurricane certification to a home increases its resale value by up to 16%, which is far more than those features cost. In 2 weeks, on February 23rd, we'll talk about earthquake stuff in response to the New Year's Day earthquake in Noto, Japan last month. Doctors Wan Feng and Yating Zhang of the U.S. National Institute of Standards and Technology will tell us about policy lessons for Canada from Japan and other earthquake-prone countries. That's in 2 weeks. But today, it's my pleasure to introduce Professor Mathieu Boudreault. Mathieu will speak about flood-related financial risk sharing in Canada, modeled flood losses, and the costing and funding of various hypothetical flood insurance plans. He'll discuss the policy implications of all of this and how we might move toward flood resilience in Canada. I'm particularly interested in Mathieu's talk today because I've been lately involved in wrapping up a survey by 2 other ICLR staff members on Canadians' willingness to pay for flood insurance. So there's a synergy of Mathieu's talk and some ICLR work that's going on. Mathieu is highly qualified to speak on this topic. He serves as a professor of actuarial science at the University of Quebec in Montreal. He's a fellow of the Canadian Institute of Actuaries, which even I, a structural engineer, understand is a big deal. He researches flood insurance and financial modeling of climate change for public and private sector sponsors. Before our speaker begins, here's our agenda. Our webinar will last 90 minutes. Our speaker will present for about half that time, then I'll moderate Q&A for the rest of the time. Please chat your questions into the Q&A box. After our speaker's finished, I will try to pose your questions in the order they appear in the Q&A box. If we have a lot of questions, I may only pose your first question, then move on to others, then circle back to your additional questions. Our webinar is recorded, and ICLR will post our speaker's slides and a link to the video on Monday or so. So if you have colleagues who could not attend, let them know. You can find today's webinar and all of our webinars at www.iclr.org/workshops. Mathieu, thanks for speaking with us today. Over to you.
Thanks very much, Keith, for the introduction, and thanks for the ICLR to organize these webinars and for inviting me. So, as the introduction said, and as the title says, I'm going to talk about considerations for a national flood insurance program. So, and this is, I would say, results from research that we have been conducting with Public Safety Canada and the Insurance Bureau of Canada. So this project is entitled Canadian Flood Risk Sharing Models in the Face of Climate Change. So this is work with Michael Boudreault from Université Laval, and also Jason Thistlethwaite and Daniel Anstra from University of Waterloo. So this is part of a research partnership with Public Safety and the Insurance Bureau of Canada. So what I'm going to, so this research project follows directly from the work of the Task Force on Flood Insurance and Relocation, so that you might have heard of. I'm going to discuss more a bit about the work of the Task Force later on. But basically, what I'm going to present today is the results from our actuarial and financial analyses under the present climate. Whereas in the second half of the project, we're going to analyze and investigate more the impacts of climate change and future climates on these actuarial and financial analyses and on policy implications as well. So, So in this presentation today, I'm going to start by providing more background on the financial management of flooding in Canada. Then I'm going to provide a summary of our findings in terms of flood risk. So in terms of, I'm going to summarize some of aspects of methodology and some important findings as well. Then we're going to move on to the costing and funding of potential insurance plans, flood insurance plans for the country. And then section 6, well, moving towards flood resilience, this will open, I will provide a summary of the findings and also some challenges for flood resilience, and that will open up the floor for more discussion and questions. All right. So financial management of flooding in Canada is a shared responsibility. So here we have the key stakeholders. So it starts with municipalities who have the responsibility for land use planning in addition to the maintenance of infrastructure. So I'm going to focus on key aspects, key responsibilities with respect to flooding, of course. Municipalities are an object of provinces, and provinces are responsible for the oversight of municipalities, flood mapping, as well. In some cases, a group of municipalities with the oversight of the province may look into the flood mapping, and also provinces are responsible for disaster financial assistance. So in case of flooding, if you're a flood victim, then you can ask for financial assistance from your province. Then at the federal level, the federal mainly supports financially the provinces through various programs. So there's the NDMP and the National Adaptation Strategy that I have listed here, but more critical for us is the DFA, so the Disaster Financial Assistance Arrangements. And also, we have insurers in the market that sell flood insurance to homeowners. So how does it work in practice? So here we have here a summary of who pays for what in case of flooding. So if you're a disaster victim and basically if the flood is covered by your homeowner's policy, then you call your insurance company and you get compensation for the losses you suffered. If the losses accumulate to a very large amount, it may cause a problem for an insurance company. So typically, the insurers also reinsure a part of their risk to the global reinsurance market. So that helps the insurance industry stabilize the financial impacts of large losses caused by flooding or other types of natural hazards. However, if the flood is not covered, so if say you are in the flood, you're living in a high risk area in the floodplains, so you might not be covered by your insurance company. So in this case, the disaster victim has a right might receive some compensation coming from their provincial DFA program, so Disaster Financial Assistance Program. So we'll summarize next what are the key features of their DFA programs, and at the bottom we have the DFA. So whenever a flood event is too large for the province to bear alone financially, then you have the federal government provides financial support to each province for catastrophic events. So the relationship remains in between the province and the disaster victim, but the disaster victim won't call the federal government for financial assistance. It always stays with the province and the municipality. So here's a summary, a bit more details here. So basically, provinces provide last resort financial assistance to homeowners and municipalities. So it's meant to support disaster victims prior to flooding. So if you want to protect your home with sandbags, for example, or after flooding. So repair, rebuild in case of flooding. So typically, it's whenever emergency measures are called upon by the province, then that might trigger also payments to their DFA programs. Then when a catastrophe is too large in terms of financial losses, then the DFA will provide financial assistance to provinces. So there's a cost-sharing formula between the province and the federal government based upon the province's population, and that establishes the financial capacity of the province. So for example, in Quebec for the flooding in 2017, the amount of eligible losses total about $400 or $500 million in Quebec. So, and they received about $300 or $350 million from the DFA to support the province in that case. So the way the cost sharing formula works is that basically for smaller events, provinces pay a large part of it. However, for catastrophic losses, for very large events, just like in BC in 21, the federal government will pay a huge share of eligible losses. In the insurance market, we have seen, so overland flood insurance and sewer backup is typically sold as a rider, as an optional rider in homeowners insurance. Whereas sewer backup has existed for a while, overland flood insurance has only been added since 2015, 2016, following the Calgary floods in 2013. What we've heard in terms of take-up rate is more or less around 50 or 60%. It changes from one province to the other for this comprehensive coverage that combines overland flood insurance and also sewer backup. Obviously, the premiums are based upon the level of risk. So flood insurance is affordable for low to medium risk homeowners. However, it is not commonly offered or affordable for homeowners at high risk. So for those who are living in the floodplains. So that's what has led the government to set up a task force on flood insurance and relocation. So how can we provide low-cost flood insurance to homeowners for those who are at high risk? So it was set up by the federal government in 2021. It was a set of meetings between Public Safety Canada, the CMHC, along with other federal representatives, provinces, and the territories, and the insurance industry. So, and that has led to a report that was released in August 2022. Based upon that report, some aspects and some recommendations were provided to the government. And in March 23, in the federal budget, some key aspects of the report from the task force were included. So we can see explicitly a reference to the creation of a national flood insurance program that I'm going to discuss more towards the end as well, and managed through a crown corporation from a reinsurance crown corporation. And it also was written about the creation of a subsidy program. So when premiums are too high for some homeowners, then there could be a subsidy program to support these homeowners. So our research project follows from the work of the task force. So the research project goes deeper into various aspects of the financial and actuarial modeling that we didn't have the time to do as part of the task force. So we basically took it from there and went deeper into the analyses and to sensitivity analyses to better inform on future policy decisions. So in this section number 3, in section 3, now we're going to dig deeper into our analysis of flood risk in Canada with some aspects here in terms of methodology. So in order to model flood risk through the entire country, we needed data on flood hazard, on the vulnerability, and on the exposure of Canadian buildings. So a key step here to assess flood risk was to build a Canadian exposure data set, a Canadian exposure information. So we did that with a set of various data sets. So we needed really the location and the property characteristics for each Canadian home, which is obviously a challenge. So we used data from the 2021 census from Statistics Canada we use the address points data set from DMTI Spatial, and we also used the aggregate exposure information from Opta to build that exposure data set. So with the information from Statistics Canada, we know how many dwellings are located in each dissemination area in each dissemination block. So if you don't know what is a dissemination block or area, it's a geographical unit where data is aggregated in the US, in the Canadian census. So on the right-hand side, there's a picture from StatsCan that illustrates what is a dissemination block and area. So a dissemination block is really a set of, is really delimited by the 4 streets. So I will just take my pointer here. So here we have one dissemination block. So it's delimited by the streets. So it's one block, basically. And a dissemination area is just a group of dissemination blocks. So it provides us information on the number of dwellings at a very high resolution here. So there's hundreds of thousands of dissemination blocks all across the country. So once we know how many dwellings there are in each dissemination block or dissemination area, the next step was also to locate each of these properties. So to assign locations to each of the residential addresses. So we did that with the DMTI spatial address points. So as you can see on the right, at the bottom right, basically it's the location of the properties. So, and after that, well, we need property characteristics as well. So is there any basement in each property? What's the value? What's the reconstruction cost of each property? So those are basic information we need in order to assess flood risk at the property level. So those are the 3 steps, well, I would say very summarized steps. And as you might have guessed, that took us a lot of time just to do that kind of exercise all across the country. So a bit more details. We decided to focus on certain types of buildings. So it's code 1 to 4, if we use the vocabulary from StatsCan. So basically it's single detached houses, semi-detached houses, row houses, and apartments or flat in a duplex. We decided to focus on these 4 because we didn't have a lot of information about multi-dwelling units. So for example, you need to know the number of floors for a multi-dwelling units to be able to determine how many dwellings there are per floor and basically how many dwellings there might be at the first floor. So that's the kind of things we didn't know. We didn't know where, let's say, the content was stored in each of these MDUs. So that's why we have excluded them. Also, we kind of guessed that the people living on the 3rd or 4th floor of a multi-dwelling building wouldn't be the ones targeted for flood insurance by the National Flood Insurance here. So we also excluded mobile homes and very specific types of dwellings. So basically, we have 10 million homes in our exposure data set. We don't have information about the first floor elevation. So that's not something that is collected basically in the public data sets or the data sets that we bought. So basically we had to assign first floor elevation. And since we had information on whether or not there's a basement, and not at the property level, but really it's aggregate information. So what we knew, for example, is within a dissemination block or dissemination area, what's the percentage of buildings that have a basement? What's the average reconstruction cost? So we didn't have any information per building. So we had to use aggregate information. Okay, so that does add some uncertainties in our analysis, but basically we have to start somewhere. So again, here the problem of the first floor elevation. So we used the proportion of buildings that had a basement. So for those buildings that we assigned the basement, we use a first floor elevation of 3 feet and 1 foot otherwise. So there's a pretty large proportion of the 10 million homes that have a basement here. So that's the information we have used. So once we set up this Canadian exposure information, we then use that as an input to the flood model. So this was, so we use a flood model by Cat Risk. This is a private vendor in the US that does flood modeling in Canada and in the US. So that does pluvial and fluvial modeling. And the output we had was the average annual loss for each of the 10 million homes. And also what was also super important for us in terms of assessing, for example, the amount of systemic risk, the cost of international reinsurance, whatever amount we needed to assess the stability of an insurance plan, then we used a probabilistic event set. So that provided us synthetic events, synthetic floods with the sum of losses provided for each simulated event. So that's a very big data set that we got in terms of simulation. So 50,000 years of hypothetical floods simulated throughout the country as of 2020. Okay, so in this table, we provide here a breakdown of the AAL, which is the average annual loss, the total average annual loss per province and also across the country. So that's on the first column here. So the AAL per province and Canada-wide. So we got a number of $1.4 billion in terms of the average annual loss. And also on the right-hand side, we have the percentiles of the aggregate loss distribution. So what it means here is that there's a 1% chance every year that the total amount of losses in Canada due to flooding is over $13 billion. There's also a 0.1% chance that the total losses is above $34 billion. So that's why we wanted to have this event set. It's to be able to understand the size of the potential of aggregate losses, the potential extremes in aggregate losses in the country. So that's really important to assess the stability of any plan over the present and also over the long term. So you have this breakdown across the provinces with the largest AAL in Ontario and Quebec. Obviously, it's proportional to the number of people living in these provinces. So, and we'll have a breakdown also divide and normalize by homeowner on the next slide here. Let's look at the distribution of the AAL per homeowner. So what this slide says, it's the distribution of risk per homeowner all across the country. So basically we had the average annual loss for each of the 10 million homeowners, and we basically rank them, okay? So what we see here is that there's a huge amount of risk concentrated in a very small number of homeowners. So there's 78% of the AAL, so 78% of the risk concentrated in 10% of homeowners. Even worse, there's 39% of risk concentrated in 1% of homeowners. So that is what is illustrated on the left-hand side in the plot. So we accumulate losses from the smallest AAL up to the largest AAL, and basically we see that it's clearly not linear. So we see this huge asymmetry in risk, I would say, where basically a small number of homeowners is driving the overall risk. When we dig deeper per province, so what we have here is the total AAL per province. So it's the same number as 2 slides ago. But here we have those numbers normalized per property. So that gives us a different picture of the risk per province. So we see that the largest AAL per property is observed in Manitoba, BC, as well as in Quebec. However, in Manitoba, I'm Well, we're pretty confident. We overestimate the numbers because we didn't have access to all of the flood defense data that is necessary to adjust also flood risk down in some areas of the country. So we know we might overestimate the AAL in Manitoba. So that's why it is the highest here. Because we couldn't include flood defense data. So that's one limitation of our analysis. On the right-hand side, in the last couple of columns, we now look at the distribution of risk in the top 10% and also in the top 1%. So what does the $123 mean is that whenever we rank the AL across the 10 million homeowners, the 90th percentile of the AL is $123, but that's the raw losses. I mean, there's it's really like losses to the building and the contents. If we move up in the top 1%, so the 99th percentile of the AL across the 10 million homeowners, then we see that the AL jumps up very significantly. So for the 99 percentile across homeowners, the AL is $3,500. So it's very much more expensive here. So here we have the number of properties per province whose individual AL is above $123 or above $3,500. And obviously the cost of housing has a huge impact in the distribution of the residential properties whose AL is above $123. So there's a combination of obviously the value of the homes and also the level of flood hazard in each of the provinces. Basically, we would expect that if it's 10%, if it's the 90th percentile countrywide, if it was the exact same distribution of risk all across the country, we would expect to see basically 10% in all of the provinces, but it's not the case. So BC here, we see 17%, almost 18%, way above 10%, but obviously the cost of housing is quite different. Same result on the right-hand side with the number of properties above the 1% threshold, which is 3,500. So it's not 1% across every province. So we have some provinces which are above that 1% threshold. All right. So we just looked at the raw flood risk. So basically the average annual loss to the building and the contents, okay? But I mean, obviously it provides us the basis for assessing flood insurance plans, but it's not enough. I mean, there's going to be additional costs that need to be incurred by a flood insurance plan. So here in this section, section 4, we're gonna look at a costing exercise for a mature plan. Why should we distinguish a mature plan from a new plan? Well, basically a mature plan, well, we don't have necessarily to take into account the size, a very large, for example, safety margin, or the fact that for a very new plan, well, we need to set more money aside to make sure that it remains solvent. So for a mature plan, it's something. So it's really like the raw costs. It's really like the basic cost for a plan, including all of the expenses, but without taking into consideration that we might need to collect more money in the first couple of years whenever it's a new plan. So the reference year is 2020 because we use exposure data as of 2020 and climate as of 2020. So here we computed the loss cost as follows. So we computed the average annual insured losses. So basically, it's the losses to building and contents after the application of a deductible and a limit. We're going to see next the effect of deductibles and limits. We added additional living expenses. We added loss adjustment expenses as well. we added the cost of reinsurance. So please keep in mind that there's a 1% chance that the raw losses all across the country is above $13 billion. So we need an external mechanism to bring stability. So it could be a federal backstop, but it could also be writing up reinsurance on the international market, or ideally a combination of both. So here we have computed various reinsurance contracts. So the price, well, I would say the pure premium of reinsurance that would be necessary, taking into account the amount of systemic risk that we get with flooding. So considering the tail risk of flooding. And we also included fixed expenses like and variable expenses, so overhead, commissions, and other fixed expenses. So as I said previously, there's a large potential for extreme losses when we aggregate losses across the country. So that's why we need to stabilize the cash flows of the plan. So that's why we need a combination of a federal backstop and then also international reinsurance. And thanks to the event set, it's something that is easy to compute the cost of reinsurance. So here we assumed that we would reinsure losses, annual losses above a given percentile. So basically, every year, if the losses are above, let's say, the 99th percentile, so above $13 billion, then there's the reinsurance kicking in at the end of the year, and this comes at a cost. So because the tail of losses is very heavy, reinsurance is going to be costly. So here, basically, we have an approximate gross reinsurance as a percentage of the loss cost of about 10%. And obviously, the more we reinsure, so if we lower the threshold for the upper percentiles, obviously, the more costly the international reinsurance is. So I think it's going to be very important to balance, obviously, the cost of capital and the cost of reinsurance, and also the cost of using like a federal backstop to stabilize the plan. So here in our theoretical exercise, we use reinsurance on an annual basis to stabilize the cost above the 99th percentile. So here's our costing exercise under full participation, and we'll discuss more about moving to a plan with fewer homeowners covered next. So here's a breakdown of costs for various plans. So for each column, you have the chosen deductibles and limits, so applied per policy, per homeowner. And in each line, it's the breakdown of the components of the costing exercise. So the AAIL is coming from the event set, where we apply the deductible and the limit for each homeowner, so for these fictitious insurance policies. And we also computed the reinsurance, the cost of reinsurance based upon the event set. So I will draw your attention on maybe the column on the right-hand side, the one with a deductible of $25,000 with a limit of $300K. That's the one that is the cheapest because, well, with a high deductible, you eliminate a lot of the small claims. For those at low and medium risk, it turns out that the cost to them is very small. The reason for a high deductible is it could be that maybe the basement is not covered, just like with the NFIP in the US. So that would also reduce the cost of the plan. So on the right-hand side, the rightmost column is the cheapest plan. So with all of the expenses, about $1.7 billion per year in terms of the annual costs. So that's the amount of money we would need on average that we could fix in the plan. And as we move towards the left, when we reduce the deductible and we we remove the insurance limit, then obviously the costs go up to 2.4 billion. So the key takeaway here is when we account for the expenses, then the annual costing of the plan is in between 1.7 to 2.4 billion dollars under full participation. That means all of the 10 million homeowners would be in the plan. You might say, well, that was not the initial idea. I mean, it was for those people at high risk. But remember, there's a high asymmetry in risk. So here we have a breakdown of the average annual losses, or the also, I would say semi-equivalently, the average annual insured losses, broken down by the level of risk. So basically here we order the AAL per homeowner from the smallest to the highest. So that's on the left hand side. So from the smallest risk to the highest risk. And on the right hand side, it's the inverse. So from the highest risk down to the smallest. So basically, if we were to cover the top 10% of risk, so that's 10% of the worst risk. So that's the AAL, that's an AAL of 1.1 billion, or basically 78% of the average annual loss. So that's the same 78% I said earlier about the huge concentration of risk. So if we were to cost a plan with 10% of homeowners, a rough estimate would be about 80% of the values before. It could be more than 80% though, because with a high deductible, you eliminate tons of small claims. So those who are borderline high risk or medium risk, I don't think they will cost a lot. So the effect of the deductible obviously has a huge impact. It eliminates a lot of these small losses for those who are at medium and low risk. So that's how we interpret those numbers here. So basically, on the left-hand side, if we were to cover everyone but the top 1%, basically it would cost approximately 60% of what we got before. So yes, it should target high-risk homeowners, but because of the high concentration of risk in the riskiest homeowners, well, basically you get most of losses and most of the risk in the top 10%. So that, I think, that's how we approach the things. We started with full participation, and we just assessed the impacts of different risk profiles, because we didn't want to model like the take up and what would be the profile of homeowners, and how much of these homeowners would buy insurance, for example. So we just wanted to highlight, for example, again, a bit more on the impacts of this, I would say, asymmetry of risk. All right, so this was for a mature plan. So what about creating a new plan? So whenever you start up a new insurance organization, or let's say in this case, a crown corporation, well, you need to have enough money aside to not go bankrupt, or to not ask for the federal government to put additional funds in the plan, because that entails political risk as well. So here in section 5, we're looking at the capitalization of a new plan. So how much would it cost initially, or how much would it cost for the federal government to replenish a fund that is fully depleted? So that's basically what we want to answer in this section. So what we do basically is that we model cash flow uncertainty, okay, for every year over 30 years. So we start with a plan, let's say in 2020, we project the cash flows in up to 2050, with cash flows every single year. So what are the cash flows? Well, you get premiums in, you get investment returns, you get reinsurance payouts if you kick the threshold. And what are your outflows? Well, obviously the claims, the payment of reinsurance premiums, and all of these expenses, loss adjustment expenses, commission overhead. that you pay every single year. So the question here is basically, what's the likelihood that there won't be enough money in the plan to continue? And if that happens, how much would it cost for the federal government to put it back on track? So that's really the objective here in this section, the capitalization of a new plan. So there's tons of things that we need to take into consideration. So basically, what are the policy terms? So deductible and limits. So as we have seen, it affects the annual costing of a plan and therefore the annual cash flows. The risk profile of homeowners. Is it full participation or just the worst 10% of risk? How much will we collect every year as a safety margin? So you could start by collecting, let's say $1.5 billion every year, okay, which is very close to the smallest amount you need every year, so on average. However, you could collect also more money every year to make sure that the plan is capitalized enough after a couple of years. So that's one strategy also to create capital. Investment policy. So where are we going to invest those funds? So what's going to be the annual return on the investments? Inflation, which is, well, obviously an issue nowadays, but it's always been the case that inflation on reconstruction cost is higher than inflation on typical goods. So that needs to be taken into account. And obviously all of these decisions in terms of how much to set aside and how much we should rely on the federal government for backstop, well, at some point, it's decisions made on based upon the level of political and financial risk that the government and the Crown Corporation is willing to tolerate. Finally, but not least, spatial dependence or spatial contagion is basically a big driver in terms of modeling. And it could be summarized as to how many floods there could occur in a given year. So how many rivers, for example, or how many cities could be flooded in any given year. So remember, 2017, there were plenty of floods in Quebec and Ontario. So that's the kind of things that we have to take into consideration. This clustering of floods that is driving the potential for extreme losses at the aggregate. All right, so we have investigated several aspects of several determinants for the funding of a plan. So here we have, so what we did is that we computed how much to set aside initially if we are willing to tolerate, let's say, a 1% or a 2% or a 5%, I would say a ruin probability, which is basically the probability that the funds are fully depleted. So this is obviously heavily dependent on the limit and deductible and obviously investment decisions, what the risk profile, the amount of reinsurance, etc., etc. So obviously the amount of capital required will move up with more generous benefits and go down with less generous benefits. The amount of initial capital required will go down if we tolerate more risk than if we tolerate less risk. So again, if we look at the sixth column here with the 25K deductible, so if we are willing to tolerate a 5% chance of funds being depleted within 30 years, then you set aside $16 billion. However, if you have much less risk tolerance, and you set aside an amount of money such that the ruin probability is 1%, then it's $30 billion, okay? The effect of risk profile. So so those numbers were based upon full participation. So those are the numbers at the top here. But so let's play with the risk profiles. So with the risk profile, so let's remove homeowners or add homeowners to the plan. So let's say we have a plan that focuses on the worst 10% of risk. So those high risk homeowners. And we fix the level of tolerance at 1%. So under full participation, we would have to set aside $30 billion, whereas with a participation of the worst 10% of homeowners, the required capital is less. Obviously, there are less homeowners, but really not that much less, so $26 billion. So there's all sorts of ways to come up with these, with different numbers. I mean, on the right-hand side, you add the key assumptions used in this capitalization exercise. So whenever you play with the reinsurance level, whenever you play with investment returns, I mean, obviously, you have higher, lower capital amounts. So that's how flexible our analysis was initially, and still is. So let's say you decide to, and again, it's always a trade-off. I mean, if you don't put that much money aside initially, well, you should expect the federal government to provide more capital injections in the future, and vice versa. So if we find that there's a lot of political risk to go back to the government to put back money into the plan to replenish the funds, then obviously we would have to put more money aside if we want to diminish that political risk. So on the left-hand side, we have the distribution of the number of required capital injections, or the number of times we ask for a federal backstop over 30 years. And without a surprise, it's heavily dependent on how much we set aside initially. So if we set aside only 500 million, so that's in red, we see that the likelihood of needing at least one backstop is quite big. So it's 1 minus 40%, so it's 60%. So there's a 60% chance that we will need at least one intervention from the federal government if we only set aside $500 million. However, if we set aside $10 million or $14 million, then obviously the probability of requiring a federal backstop is much smaller. On the right-hand side, it's also the sum of the amounts required in the plan over 30 years whenever we need federal intervention. Obviously, the smaller the amount of money we put aside initially, then the larger the capital injections will need to be. And I would also add that it would be important to put more money aside initially because you will want to benefit from investment returns. So if you put more initially and you benefit from investment returns, and let's say you're sufficiently lucky to not have to pay a lot of floodings in the first couple of years, then you will probably have enough capital in the first few years to have something stable that without requiring further capital injections in the future. So it's always, so again, here in this case, the key takeaway is to remember that it's always a trade-off, okay? So the lower the amount of money you put aside initially, the higher the number of interventions and the higher the amounts that will be required by the federal government for the future. Last but not least, the impact of spatial dependence. So something that actuaries also need to do is to assess how much flood contagion there could be all across the country. So that's why I said, like in 2017, how many of these rivers could flood because of the climate, for example, just like we got in 17, a huge snowstorm in April, and then very quickly the snow melted with rain and high temperatures. So that brought a lot of floodings in Quebec and Ontario. So what the catch risk model tells us is that basically there's a 1% chance of paying more than $13 billion every year. But when we play with that assumption of spatial contagion, it could be in between $5 billion or $32 billion. So that's really informative whenever we want to assess the level of systemic risk. So we should not use the 5.6 billion figure here because it assumes that basically flooding across the various watersheds or basins is totally independent, which is not the case, okay? Embedded in catch risks model, there's spatial dependence that leads us to approximately $13 billion in terms of the 99th percentile. But when we use a heavy tail dependence assumption, it might go up to 32 billion. So it's important to keep that in mind, that it's a very important modeling assumption, a spatial dependence. And for whatever considerations of how much we should set aside and systemic risk, for example, in the financial system, that's a very important assumption. All right, moving on to concluding remarks. So some key takeaways, as I said previously, annual recurrent costs, including expenses, should be in between $1.7 to $2.4 billion every year under full participation. If we were to move to a plan that covers, let's say, the highest 10%, well, it's not 10% times 2 billion, obviously, okay? There's too much concentration of risk in the top 10%, so it's basically or roughly 80% of those amounts that we should pay every single year on average. The initial capitalization is very sensitive to many determinants, as I said previously, and as I have insisted, there is a huge trade-off between high capital and low capital injections and vice versa. Given how much of the overall losses that the top 1% of homeowners accumulate, I think it's fair to think about a solution for the top 1% of homeowners. So they account for nearly 40% of the risk, 39% according to our model. So there should be something that we should do for that top 1% of risk. So here on the slide is the current state of affairs. So I asked Public Safety Canada what I could say in terms where we are in terms of the discussions. There's not much I can say. As you can see on the slide, it's basically same information as on the budget. So the 23 budget has put aside money to the CMHC and Public Safety Canada to stand up a low-cost flood insurance program. There's also mentions of affordability subsidy in the budget, and it should be targeted to those who are at high risk of flooding. High risk, still yet to be defined. They are currently engaging with provinces and territories, and obviously there are ongoing discussions with the key stakeholders with respect to the flood insurance program in terms of the key parameters that need to be decided. And there's also considerations for inclusion of earthquakes and also other climate-related risks also in the future through the Crown Reinsurance Corporation. I think that it's great news that the government is moving forward towards a reinsurance corporation, the Crown Reinsurance Corporation. I think it's a great tool for the financial management of flooding in the country. So it helps us foster the pooling of risks from various natural hazards. So not just flooding, but flooding now or earthquakes tomorrow. So that's basically, that could be a powerful tool for many stakeholders. So not just insurers, but also provinces and municipalities to help manage their own risk from natural hazards, from flooding, but also maybe from other types of hazards. It could probably help also depoliticize post-disaster recovery, hopefully encourage best behaviors. I see a lot of benefits in that Crown Corporation. So I'm hoping that in the future that those objectives will be met. Challenges ahead. So as I told you before, the second half of the research project will focus more on climate change. So it is expected that climate change will put pressure on the new flood insurance program, and also on insurers. But it's also super important to keep in mind that climate change won't affect similarly pluvial or fluvial flooding. And basically it won't affect similarly sewer backup and overland flooding. So some extra considerations here. So with a warming atmosphere, typically you have more extreme precipitations and also more severe droughts. So let's say over the summers, so some of these extremes that we have seen, some of these heavy rain episodes that we have seen in the summer of 23, we should expect to see them more often. So I think in terms of sewer backup, we will see more of these flooding in the future. In terms of overland flooding or fluvial flooding in our case, so the overflowing of bodies of water, it's not entirely clear. If you look at the report from Environment and Climate Change Canada, depends a lot on the regions, and it depends on the drivers of fluvial flooding. So whenever you have snowmelt dynamics, I mean, with warming, typically you would have a smaller snowpack, which means much less snow to melt in the spring. However, when you have frozen grounds and you have heavy rain in January or February, because with a warmer atmosphere, it's more likely, then you have a much easier runoff. So you have the water basically going on frozen ground. So there's no absorption. So that might also create more flooding as well. So wherever it will go in terms of directions, clearly needs more investigation. So being able to separate both is really important. And also, I think we should keep in mind not just mitigation, but also adaptation of our buildings and infrastructure. So let's keep in mind in terms of building back better and updating and maintaining our infrastructure. We also have moral hazard issue in terms of the governance of flood risk. So as of today, with the structure of a DFAA and provincial DFA programs, you have municipalities responsible for land use planning. So they have both hands on the wheel in terms of deciding where to build, whereas you have the federal government that pays up a pretty large amount of losses for catastrophic events. So basically, what it turns out is that provinces and municipalities have fewer incentives or limited incentives to reduce flood risk. Okay, so basically provinces are responsible for the municipalities. So basically, if you have the federal government that is paying for a large share of losses based upon the decisions taken by the municipalities and the provinces, that creates a moral hazard that could be solved or alleviated or mitigated by having the provinces participate more explicitly in the funding of, let's say, the DFA or the future flood insurance plan or the future affordability programs that could be set up. Okay, so I think it's important to link the financial responsibility with the ability to take decisions that can reduce the amount of flood risk. And again, let's keep in mind that climate change is going to put pressure on flood and flood insurance. So there needs to be mechanisms to reduce flood risk or reduce or mitigate the impacts of flood risk in the future, especially in a context with a housing crisis where we're going to have to build more and quickly in the future. So I'm hoping that this won't be done without keeping in mind that we should keep people out of the floodplains. There's a lot of challenges also in terms of the data. So in terms of flood hazard modeling, so high resolution terrain models that are not available everywhere. You have a low density of hydrometric and weather stations, especially when you compare to the US, which it makes it hard in certain regions of the country to have a better understanding of flood risk. We encountered issues in terms of getting access to exposure data, so often incomplete data for the building footprints, property characteristics. I don't think we have data for the first floor elevation or very limited data on first floor elevation, which is critical to analyze the vulnerability of buildings. And also assessing the link in between the exposure and the losses, so the vulnerability of our buildings. Canadian damage curves. Okay, so there are a few studies that have been accomplished before, but I know that the damage curves from the US are still very useful, but it's still difficult to have our own Canadian damage curves because overland flooding was the losses from overland flooding was mostly paid out by the provinces in the past. So each province have different data collection mechanisms, and also it's basically locked in with the provinces. So with that opens up the floor to questions and discussion. Thank you.
Thank you, Matthew. That was awesome. Great topic, really well presented. I am going to lead off with a question of my own, and then I'm going to turn to the questions that got chatted into the Q&A box. First, my question is, I want to probe your judgment about the effect of exogenous model uncertainty. And for the 99% of participants who don't know what that means, exogenous means uncertainties that are outside of your model. One can imagine using a different vendor's cat model besides cat risks, which has its own built-in hazard and vulnerability model. Or one can imagine a different bunch of footprints where you know better elevation of the first floor and whatnot. So this is going to be hard, but pick a key model outcome like average annualized loss at the national level. How sensitive do you think that might be to exogenous model parameters? I know this is a wild guess, but how much different do you think a different cat model might give you AAL or a different model of footprints?
Okay. I strongly believe that the huge, I wouldn't say huge, but a large proportion of the overall amount of uncertainty is driven in the flood model and the underlying assumptions. Obviously, vulnerability modeling, the fact that we don't have much in the country does make a difference as well. But I think a large driver is in the flood model. However, in order to be able to say that, we would need to have plenty of data sets to analyze the sensitivity of the overall results, and being able to say, okay, 60% of the uncertainty is caused by the flood models, 30%, let's say it's the damage curves, 10% it's the assumptions on the exposure. But we are not in a position to say that. There's, being able to assess just the uncertainty with respect to flood models, I think for me, it would be a great research objective for the future. We had access to cat risk, and thanks to cat risk, we were able to do that. I know public safety did that. I mean, they used 3 vendor models, but still with US damage curves, if I remember correctly. So, but again, being able to assess the share of the uncertainties in each component, it's very challenging, and sometimes we don't even have the luxury of having a Canadian model for damage curves. So I cannot tell you what's the share by assessing different damage curves, but we could run a sensitivity analysis and say, let's say it's that hypothesis instead, and look into that. But I would say my gut feeling is whatever is closer to the climate and closer to the hazard.
Sure, but I guess what I'm asking you is if 2 people just like you did similar models using some other vendor model or some other vulnerability model, how wide do you think the differences would be between, say, 3 different analysts like you? Do you think your numbers for AAL are accurate within half an order of magnitude, less, more?
Public Safety Canada came up with a $2.9 billion figure. They had 15 million homeowners instead of 10 million. That's because they included multi-dwelling units. So I don't think that those multi-dwelling units account for a large share of losses. But you can see the margin in between 1.4 and 2.9 because they use an average of 3 vendor models with 2 different set of curves. So as you can see, I think the MDUs, they probably account for maybe because they included the contents, so might be 20% of the maybe much less than 20%, but from 1.4 to 2.9, there's obviously a huge margin in between the two. Yes, they accounted for territories, but I don't think that's a huge driver either. But
So
what I do
within
know is that there might be a factor of 2 or 3 in between the models, Canada-wide, and then once you zoom in per province, it can be much bigger than that. Yeah.
Yeah. Okay, great.
Because
Thank
the
you so
errors I would say the errors would tend to cancel out on the aggregate on the at a large scale. But I mean, judging from the 1.4 to 2.9, I mean, it was also a model average in this case. I mean, yes, there's obviously a huge discrepancy.
Awesome, thanks. And that's just the reality of forward modeling. A great deal of uncertainty.
It's highly complex. Yes.
Sure, absolutely. Our first question from our attendees from Robert Chamoun, who asks, did you assume a specific distribution or methodology when sampling the reconstruction cost?
Okay, so within a dissemination area or dissemination block, indeed, we add the average reconstruction cost. We just use the average. We could have randomly sampled amounts or stuff like that. But given that we add aggregate information, that's probably the best estimate we could use. And why we were afraid to use other assumptions is that, let's say, by coincidence, we put a high reconstruction cost really like in the floodplains within a dissemination block, whereas elsewhere in the dissemination block, we put a higher reconstruction cost. So that adds just more uncertainty, which is probably a bit more realistic, but that just adds up some uncertainty. We are currently writing down the paper, and we have assessed a portion of the uncertainty for the exposure data set with the Quebec data. So instead of using the MTI and using StatScan for determining the number of dwellings, we use data from the Quebec government, so the Ministère des Affaires Municipales. So we had access to their data. But we use the catch risk and other Opta information, and it's not that different. And we were quite reassured that at least at that stage of the modeling of the exposure in terms of the number of dwellings and how we assigned reconstruction cost, it's not that bad. But that's the only portion we know because we had access to the data from Quebec. But I mean, it would be great if we could run the catch risk model every single time we change the exposure assumption, which we couldn't based on our license.
Understood. Brant Wifferman asks, how did you choose which private flood model vendor to use?
We catch risk add probabilistic event set. So that was reason number 1. Reason number 2, having a vendor that provides an academic license at a reasonable cost. That was also reason number 2.
Yeah, absolutely, thanks.
But there's 3 vendors. There were 3 vendors back then, so there wasn't a lot of choice. So
gotcha. Slobodan Simonovic says, thank you, Matthew. A few questions and comments. His first, and I'm going to come back to his second and third later on, but his first was, how is home value determined in the vulnerability analysis?
That is part of the output from catch risk. So we provided the exposure data set. When you look at the documentation from catch risk, basically it's based on the information from the US. They have a 4-parameter beta distribution. So basically they randomly simulate losses based upon the flood depth and the first floor elevation. But I mean, I don't have much more details as to how losses were modeled.
I think he may be asking about exposed value $350,000, $200,000, $500,000
Oh, the
for
reconstruction costs, for example?
construction. Maybe that's what how I read it.
Ask Opta.
Okay. Camilla Flores asks, how's the flood risk concentrated between pluvial and fluvial flooding?
We didn't investigate that because as part of the event set, it's basically a combination of all sources of flooding. We now have access to the separation between pluvial and fluvial for the present climate. So that might be a question I will be able to answer in the future, but not now.
I would love to hear that the answer to that question too. Thanks for asking that, Camilla. An anonymous attendee asks, I'm curious to know if the public can access data that compares flood risks per municipality, if we can get that specific.
Other than downloading like the flood hazard maps or flood risk maps that are already available, or waiting for the portal that Public Safety Canada is going to set up with NRCan. I don't think it's that easy. You would have to work with a professor or with Dr. Simonovich, or maybe also contract with the vendors and just restrict like some of the areas you want to investigate, but that would be at a cost.
Well, when is that portal going to come out, do you think?
I have no clue.
Okay.
There's an amount that was budgeted in the budget and the federal budget in 23 for the portal. But I mean, they have to talk with provinces and municipalities to collect all of the information. I don't know whether it's going to be standardized or presented in a standardized way, or I have no clue about how it is going to look like. But I know it's in the plan for the future, apparently for homeowners to be able to know more about their flood risk.
Cool.
Through the portal.
Next question is from Jessica Showbridge. She asks, can you explain the exclusion of coastal flood hazard?
I don't think it was necessarily part of the initial discussion of the flood insurance program, or I don't know if it was just a limitation of the hazard model. I know some of the vendors do include coastal flood risk, but I mean, unfortunately, other than telling you that was part of the vendor model, I have nothing smarter to tell you. I'm not entirely sure if coastal flooding is supposed to be part of flood insurance. I think yes, because I think it was included in some of the analyses of the task force. But yeah, it could be for future research.
Kevin Smart asks, he says, I'm a co-author of a recent report commissioned by the Assembly of First Nations. The report studies access to flood insurance for on-reserve homes. Does the model of flood risk losses include damages for First Nations on-reserve housing?
For all of the exposure data, if the exposure data, if it was in the exposure data in the 10 provinces, because we had to exclude the territories as part of the coverage of cat risk. So if it was in the original exposure data, that is within StatsCan, within the MTI, then the answer is yes.
Okay, you don't know whether it was or not. Eric
Guthrie. We didn't isolate those. We didn't isolate the reserves in our analysis. We always work in the aggregate. So
I understand. Eric Guthrie asks, to what extent does an assumption matter about how many times an owner may claim under the program? Was any consideration given to an arrangement where an owner of a flooded home could claim only once, only twice, and so on, where after that exposure was dropped from the program?
I know in Quebec, there's consideration for successive flooding. So if you're flooded once or flooded twice, as soon as you reach a lifetime limit, then apparently you won't be covered anymore. As to whether the government will really apply that in practice in the near future, I don't know. But I know it was part of the discussions whether or not we should have because right now how it's made, someone could be flooded every single year if someone is really unlucky. So there was no consideration for removing homeowners, for example. But it's certainly something we could do in the future. I mean, we have data, well, simulated data per dissemination block. So let's say we have a few homes that are flooded unluckily a couple of times within 10 years. We remove those homes from coverage, for example. So that could be a way to reduce risk, or basically transferring the risk back to homeowners. But if the goal is to lower the costs, that's something that is feasible. But right now, I mean, everyone that is flooded once, twice, 3 times is going to be compensated. So
Great. Shuyi Chu asks, based on asymmetry of flood risks, does it make sense to shift or expand any cost-sharing formula from purely population-based to a risk-based formula?
okay. When I see cost sharing formula, population based, it looks like the cost sharing formula from the DFA. So indeed, the DFA is based upon the number of people. That's a very raw estimate in terms of the financial capacity of each province to assume like the losses. I think it could make sense, but at some point that would also skew the results based on the costs of housing and the costs of reconstruction. So let's say you have the exact same amount of water in the basement or at the first floor for a similar house. It won't cost the same across the provinces. So there are obviously those kind of considerations that should be taken into consideration. Yeah.
Thanks. Mike Hatfield asks, if the top 10% are supported through a funding model, as you've described, do you expect commercially available rates to fall in cost, or will all flood insurance have to be funded to ensure that flood insurance has a reasonable cost in Canada?
Okay. Well, there are many things to take into consideration about a future plan. If the top 10% ultimately becomes within the responsibility of the insurance industry, obviously risk-based premiums will be very high. So the federal government and the provinces will have to step in and provide subsidies, for example. So whether or not the rates will fall in cost, I think from the perspective of homeowners, it will obviously depend on the structure of the subsidy programs and how much the other stakeholders participate in the funding. But if it remains strictly in between it won't be viable if it remains within the industry and the homeowner. So we always take for granted that there will be the federal and the provinces providing some sort of subsidy program for these premiums, because otherwise it's not going to work. So
thanks. Greg Steed asked a question that also occurred to me. Thank you for asking it, Greg. I'd love to know if discussions have occurred around how to distribute these funds to vulnerable Canadians. He's asking, are we concerned about subsidizing wealthier Canadians for living in higher risk areas?
Of course, those are key aspects of a subsidy program. I mean, we shouldn't be just looking at the AAL, because the AAL is looking at the hazard and the value of the home. There's also consideration for the income of the homeowners. So should we be looking at only the flood hazard in itself? But if the flood hazard is high or medium for I don't know, for a $2 million home, obviously the premium will be high, but maybe the homeowners, well, can't afford these premiums. So all of these should be taken into consideration. And that's very important policy considerations for an affordability program. You don't want to provide a subsidy for high incomes just because their home is valued as high value. So yes, this is a huge concern.
Great. Jay Kang asks, to what extent does your analysis include the impact of urban flooding, which is primarily sewer backup losses with concurrent flood events? So I guess that's sort of getting at the same, can you break out fluvial, pluvial, and, and finer breakout between the causes of
Yeah.
flooding?
In theory, whatever is pluvial is included for concurrent flood events. I would have to look into the documentation as to how it has been accounted for, whether or not it's entirely separate or taken into consideration. So,
right. Tahara Yasmin says, thank you, Matthew, for your excellent presentation. Would you share your presentation as copy? Tahara, we always do that. Matthew is going to, if he hasn't already done so, he's sending me a PDF of his deck, and we will post it along with video by Monday afternoon. So you just have to check in at that that website I mentioned a little bit earlier, www.iclr.org/meetings, I think it was, and you'll find the, let me just double check that. I say it every time and I forget what it is every time. Workshops, not meetings, workshops. So let's see, coming back to Robert Chamoun, Robert Chamoun, he provides some information. He says, FYI, the cooperators already has a portal to assess flood risk per property. Cool. Thanks, Robert. Coming back to Slobodin's second question, in the AAL analysis, how are probabilities of 1 in 1,000 years determined?
Okay. So basically, the computation of the AAL is based upon their own, based upon cat risk's own flood hazard model. So I think they have run hydrodynamic models at 30-meter resolution for various return periods. So that obviously is a driver of the AAL. So, I mean, when you have the losses assigned to all of these return periods, with respect to the uncertainty, with respect to 1,000-year kind of event, and yes, there's tons of uncertainties, even at more frequent floods. Unfortunately, I wouldn't be able to answer that. I would have to go into the documentation or ask questions to cat risk. So,
okay, thanks.
You know what? Not being able to rely on our own flood hazard model, or I mean, obviously, comes with a set of disadvantage. So, we had access to the flood vendor from the vendor model. It's really useful to run our actuarial analyses, but I mean, for us, it turned out to be a bit of a black box, that kind of flood hazard modeling. But I mean, not an engineer myself, but that's why we focused on the actuarial assessments and financial assessments. But these are the kind of things we could look into by talking with a vendor.
By the way, to the attendees, Robert offers in the chat, in the Q&A box, a URL to the cooperators risk portal.
Yep.
Let's see. David Charest, I'm sorry if I'm mispronouncing your name, says, considering flood risk is higher in a zone where is higher in places where vulnerable people live, $5,000 deductible could be too high for them. What would be the result with lower deductibles, say $500?
We did run an analysis with $1,000 deductible, so I don't know exactly how much more the plan would cost. I would have to ask Gabriel, who did the grad student who did most of the computations. But yeah, as you would expect, the plan would be more expensive, and it also depends on the limit that is chosen. But I totally agree. $5,000 is still it's hard to swallow for many homes. So
Yeah. Coming back to our anonymous attendee's second question, how are you taking into account the worsening impacts of climate in your risk and vulnerability modeling, which might be in flux as a result?
yeah. So in our 30-year projection, because I mean the costing analysis was everything was based upon the exposure and climate of 2020. But for our projections over 30 years, it's as if the climate remained the same, which is obviously a strong assumption because we just wanted to know about the impact of the uncertainty of the claims from one year to the other. But that's the goal of the second half of the research project, is to take into account climate change into our analyses and how much it affects the costing and the funding and eventually potentially like policy implications.
Awesome. We have a bunch of questions left, but we are out of time. So I want to thank you, Mathieu, once again for a great talk, a really fascinating a model with a lot of detailed results presented. We're very grateful. So thank you so much, and thank you to perhaps a record number of attendees today. Nice work, Mathieu, for bringing in over 130 attendees.
Wow, great.
Remember, everybody, to join us in 2 weeks if you are interested in earthquakes, to hear about earthquake mitigation policy lessons from the Japan earthquake. And with that, I will thank you all for attending, and I hope to see you next time. Bye-bye, everybody. Bye, Mathieu.